life insurance companies are making 1%, but guess what? You're getting something useful in exchange for that 1%, which is a death benefit that doubles as long-term care.
So what are the expenses of a LIRP and how does it compare to other possible options?
Yeah, so that's a great question, and it's a question that we get asked a lot. And so I usually explain it in the following way. These expenses are higher in the early years, but they're much lower in the later years. But when you average it out over the life of the program, it should cost you less than 1% of your cash value per year. Okay. How does that compare How does that compare with some of the other options that you might experience? Well, according to all the third-party studies, a 401k from a mid-sized company is going to cost you about 1%. When you figure all of the expenses, all of the administrative charge, all of the 12B1 fees. So the moral of the story is whatever road you take in life, somebody's making 1%. In this case, the life insurance companies are making 1%. But guess what? You're getting something useful in exchange for that 1%, which is a death benefit that doubles as long-term care. And so if you're already paying, 1% wherever your money is currently being held, like whether it's with a 401k or wherever, you're not really paying any additional money here. You're taking money that would have otherwise grown in that environment where you otherwise would have paid that 1% fee. You're dumping it into a bucket, the cost of which is 1% per year over the life of the program on average. And you're getting something useful in exchange for it, which is that death benefit that doubles as long-term care. So really, these programs only really work if you keep them until you die. It's sort of like getting married. Marriages work best when done till death do you part. These programs are sort of the same. And so it makes sense if you're going to keep it for 30 years to look at the expenses as an average per year over that 30-year time frame. And if you do, you'll find that it compares very favorably. In many cases, the longer you keep it, the less expensive it gets in terms of the internal rate of return. It can actually be much less expensive than your 401k when it's being structured in the way that Charles is having you structure the programs.
Dave, I've been getting a lot of questions about LIRPs. And one of the biggest questions that I've been having is when we make a presentation on a LIRP and suggest that this is the amount that's recommended based on that person's case, sometimes we get a question, well, what happens if I put in less? And I wonder if you could talk about the impact of LIRP deposits and LIRP funding and how that impacts the outcome.
Yeah, so I mean, if the recommendation is it's $20,000 per year, and you sort of balk at that and you say I only want to put in $10,000 per year, it's pretty it's pretty straightforward. The amount of money, tax-free money you can take out the back end will be half as much, right? So it sort of reduces proportionately. Now, the real question you have to sort of ask yourself is why are you thinking about doing an LIRP to begin with? Now, there's a number of good reasons why you would have an LIRP. There's a number of good reasons why I have an LIRP. One of the big ones, particularly for people that are 50 or older, and the closer you get to 60, the more of a burning platform this is for people. And I always joke about it a little bit this way: what does a 60-year-old couple have four of? And I get all sorts of different answers. They got 4 kids, they got 4 dogs, they got 4 eyes, 4 legs. No, you got 4 parents. And what's the likelihood that one of those parents is going through a long-term care event even as we speak? It's pretty high. All of my grandparents experienced long-term care or needed long-term care. And some of them rotated between the children that were willing to sort of put them up. Some of them went to Medicaid-funded facilities, neither option of which is really awesome. And so the question is, how do you deal with long-term care without the heartburn that goes along with traditional long-term care approaches? And what is the traditional long-term care approach? As you buy sort of an expensive long-term care policy, they're very, very expensive. They can be very hard to qualify. You might live to be 120, but if you have a bad back, a bad hip, a bad knee, you may not even get accepted. And what happens if you pay for 30 years, die peaceful in your sleep, never having used it? Do they send you all your money back at the end? No, it goes to pay for someone else's long-term care, and that can be a source of heartburn for a lot of different people. I would say 80% of my clients who use LIRP at this stage in their life are doing it because they have the ability to receive their death benefit in advance of their death for the purpose of paying for long-term care. And if they die peaceful in their sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit, probably their kids or their grandkids. So there isn't that sensation of having paid for something they hope they never have to use. So back to the original question, let's say you're putting in $20,000, I don't know, over 8 years, and that gives you that maybe that gives you $8,000 worth of long-term care per month. If you decide that you don't want to put in the 20, you put in 10, well, that's going to get you about $4,000 worth of long-term care per month, which may or may not be enough to cover the bogey as far as long-term care expenses go. So really, whatever the benefit is, whether it's tax-free income at the back end or a death benefit that doubles as long-term care, if you put less money in, you're going to get less benefit proportionately on the backside.
We talk about in our study groups from time to time with you and your folks that a LIRP is in one respect just moving money from one pocket to the other pocket. We're taking it from the taxable pocket, settling up the taxes that we owe them, we just do, and then moving from that point forward in a tax advantage vehicle. Is that a fair way to describe it?
Yeah, I mean, whether it's a Roth IRA or an LIRP, the cost of admission is you got to be willing to pay a tax. You got to be willing to, pay tax on that IRA or 401k today. But the good news is you're going to have to pay that tax sooner or later. You might as well pay it while it's on sale at historically low tax rates while we've got this little window within which to enjoy historically low tax rates. So whether you're putting money into a Roth IRA or an LIRP, the cost of admission is you got to be willing to pay a tax. I give you permission to not enjoy paying that tax, but just when you put it in a perspective, you're going to have to pay that tax sooner or later. You might as well pay it while it's on sale.
And at a controlled rate that you can kind of project and manage rather than a future uncontrolled rate. Speaking of tax rates, do you have any thoughts on the path or future path of capital gains rates?
I don't have any inside scoop, but I can tell you what my hunch is. My hunch is that as we slowly slide into insolvency, and I used to have people argue with me about this. Dave, we're not sliding into insolvency. And then more and more experts came over into my camp, and now very, very few people argue that we are on this collision course with insolvency. I often talk about David Walker. He's actually from Connecticut, and David Walker has talked about how tax rates have to double just to keep our country solvent. He's been sort of barnstorming across the country, raising the warning cry to whoever would listen, basically for the last 20 years, trying to raise a warning cry on the insolvency issues and the unstable fiscal footing of our country. And he's basically said that tax rates have to double to be able to pay for all the promises that we can't afford to keep. So it's not enough to tax the wealthy. They're going to have to broaden the tax base, and sooner or later, even middle income America is going to have to ultimately fall under the scope of the IRS's taxation. So, and the Committee for a Responsible Federal Budget has said that it's not enough to just tax the 1%. You're going to have to broaden the tax base. Everybody's going to fall under that scope. And so that means the 40 trillion or so that are sitting in IRAs and 401ks all across America, people are going to have to pay higher taxes on those accounts as well. And so whether it's capital gains or income tax rates, I think that it's all likely to go up. I think they're going to, it'll be pretty tough if they just raise income tax rates. I think they're going to try to create a mirage that tax rates aren't really going up by maybe increasing FICA tax rates, increasing individual income tax rates, increasing capital gains tax rates, so that you have sort of this broad-based increase in taxes on pretty much all Americans. LIRPs have what I like to call sort of a marination period. These are not short-term accumulation tools. You don't want to put money in with the intent that you're going to take money out 5 years from now or maybe even 10 years from now. They need to sort of build a head of steam. And that's why we advocate for multiple streams of tax-free income. If you have 6 different streams of tax-free income, you won't feel any pressure to take money out of your LIRP in the first 10 years. By the way, if you're 55 or 60, chances are you're going to live for 30 years. So it's okay to, forego taking money out of your LIRP for the first 10 years because you'll have another 20 years down the road. And for a lot of people, the main motivation is that long-term care down the road. And so, the way you take money out of these programs is generally by way of a tax-free, cost-free loan. Okay. So basically what happens is you call up the insurance company, you say, hey, look, I want to take money out of this policy by way of a loan. And they say, well, you're not actually taking money out of your policy. We're actually cutting you a loan from our own coffers, and we're using the cash value in your policy as collateral. And so, for example, we are going to charge you, say, a 3%, loan interest rate. But we're going to take money out of your cash value and put in what we call a loan collateral account. And in that loan collateral account, we are going to credit that money at 3% per year. And so a lot of what these companies do is they say, we're going to charge you 3% on the one hand, but we're going to credit that 3% right back to you on the other hand. So all you know is that you asked for, say, $100,000, you got $100,000, your cash value went down by $100,000, and you didn't have to pay tax. So it's what a lot of people have been using as a complement to the Roth IRA. The net effect is you feel like you took a distribution from your Roth IRA because you didn't pay tax, you didn't pay fees. The net cost to you was zero. And so it's just a different way of experiencing tax-free distributions that, like I said, can be a good complement to your, the tax-free distributions you might take from a Roth IRA or a Roth 401k.
Awesome.
So in the case of long-term care, you can do that year after. Are there restrictions on that?
Yeah, so to be able to take it out for long-term care, you have to get a letter from your doctor that says you can no longer perform 2 of 6 activities of daily living. You can no longer feed yourself, bathe yourself, transfer yourself, what have you. Find one doctor to write one letter to that effect. And they will start sending you basically 25% of your death benefit, or if you prefer, roughly 2% of your death benefit per month every year for 4 years. So there's a trigger there to be able to get it for the long-term care, because with the long-term care, what you're doing is you're getting your death benefit in advance of your death, not your cash value. You're getting your death benefit in advance of your death for the purpose of paying for long-term care. It's a lot easier to just take a tax-free loan from the insurance company using your cash value as loan collateral. It's a lot easier to do that. You can do that pretty much anytime you want, so long as you've got some accumulation value that's built up in the program. If you need help creating a balanced, comprehensive approach to tax-free retirement, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. And if you found value in this video, don't forget to like, subscribe, and hit the bell so you never miss another one. This is David McKnight. Thanks for watching, and I'll see you on the next video.